Good afternoon, everyone. Thank you for joining us today. We hope you're doing well and staying safe. My name is Maria Asher, and I'm part of the investments team that manages the Westward Select strategy. Today, we wanted to talk about our outlook for the large cap value stocks and the opportunities we are seeing in that space. For that, we have Leah Bennett and Matt Lockridge joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on Select Strategy. Matt is a senior vice president and co-director of equity portfolios. He's also the lead PM for our large cap value strategies. With that, I'll hand it over to Leah. Hi, Leah.
Hi, Maria. Thank you so much. And Matt, thank you so much for joining us. I guess anytime we're talking about a investment strategy, it's great to start with the research process. So I'd love to have you talk a little bit about the research process and kind of how do you look at stocks?
Sure. So thanks for having me, first of all. We are value investment managers, but we do focus on the higher quality end of the spectrum. So we're not trying to invest in distress type situations. We're not going after deep restructurings or turnarounds. We're really essentially trying to buy great businesses when they're trading at a discount to intrinsic value or a discount to what they're truly worth. And we do this through fundamental bottom-up research. And really key to our process is buying these great businesses when there's some type of skepticism or overhang, some underappreciation of the future earnings potential, because that helps limit the downside risk when we invest. When there's that skepticism, it creates a margin of safety, and we take advantage of that. And really, so key to our process is only swinging at the pitches when we think there's limited downside and significant upside. And as we build portfolios, we're building them from best ideas that come from our research team. We take a very long-term approach. This is a low turnover. We're typically holding these businesses for 3 to 5 years, so we're not racking up significant gains. We're really investors, we're not traders. But again, key to our process is that limited downside risk.
And limiting downside is certainly something that everybody always cares about, but in particular is something that's been a focus really during the first part of this year. You mentioned value, and there certainly has been a wide performance gap between value stocks and growth stocks over the last several years. Can you talk a little bit about that valuation or the performance gap and make the case for value a bit?
Sure. So just to kind of step back and frame it for those that are perhaps less in the know on the value growth phenomena. Basically, over the last 5 years or so, the growth index has significantly outperformed the value index. And leadership in the market really ebbs and flows. So there's periods in an investment cycle where value will outperform. There are periods when growth will outperform. And typically, if you look back over cycles, what you'll see is value tends to outperform early in an economic cycle. So if you look at 2009, after the great financial crisis, from the bottom in 2009 until really 2015, value outperformed growth. And what we mean by that is the value indice or index outperformed the growth index. But really starting in 2015, growth started to outperform. And that's really been the case over the last 5 years or so. And so we are seeing some green shoots now that we've had a down cycle and we're starting to see the economy recover. Really over the last couple of months, we've seen value start to regain that leadership, which is a good thing to see. But I've really been pleased, frankly, with our entire research team as we've been able to outperform that value index really over time and consistently. And I think part of that is really due to our philosophy, focusing on quality businesses. We're not investing in just cheap companies. We want businesses that grow their value over time, but we just want to buy those great companies at a discount. And so I think that focus on quality has really allowed us to outperform the broad value index.
And it is good to see the shift in the market lately towards value, which is always healthy to see the market rally broaden out a bit. And speaking of rallies, I'm kind of curious what your thoughts are about the market in here. It's been I think a lot stronger than what a lot of people initially thought. And it's a question that we get quite a bit from clients.
Sure. So we have had obviously a very strong rally, and it continues today, actually. And I think it's important to remember how much money we've thrown at this problem. When you look at the Federal Reserve balance sheet and all the liquidity that they've added to the system, it really is unprecedented. Actually, over the last year, we've had around the world close to 200 rate cuts by central banks. And when you add in fiscal policy measures, when you add in quantitative easing to those interest rate cuts, we've had roughly 500 easing events. And so all of that liquidity flows into the market. It helps fixed income securities and it helps equity securities because it's inflating asset prices. And so I think part of what you're seeing over the last couple months, that reinflation in asset prices, is really coming from the Federal Reserve. Now, we do think economic fundamentals will likely trough in the second quarter. And so we have this interesting phenomena of liquidity helping multiples of stocks, but we also have the fundamentals improving. And so that to us is the reason why you're seeing such strong action in the equity markets.
I think that's great. Wonderful perspective. Another question that comes up quite a bit and is actually a sector that's starting to perform much better are what are your thoughts on financials? In particular, as we've seen unemployment rise significantly, how do you think they're reserved, and maybe how are they positioned a little bit better versus how they were during the financial crisis?
Sure. So it has been a rough few years for the financial sector, which is incorporating banks, obviously, also insurance companies and some processors. And some of that difficulty has really been because interest rates have been so low. Interest rates essentially have been pegged at zero. Real rates have been negative. And that's just a difficult environment for banks specifically and their traditional businesses. But what I would say is, from a fundamental standpoint, these businesses really are on better footing than in the financial crisis. So, for example, Bank of America, one of the industry bellwethers, in their first quarter report, their capital level, or tangible book value per share, is 75% higher than it was in the fourth quarter of 2009. So after the financial crisis in 2009, compared to today, capital levels are 75% greater. And when you think of credit quality and the risk that credit deteriorates over the coming quarters, if you look at their charge-offs, again at Bank of America, charge-offs in the most recent quarter were only 10% of what they were in the fourth quarter of 2009. So we feel good about capital levels. We feel good about credit quality and reserves. And in fact, another institution, JP Morgan, was just at a conference last week talking about reserves. And their comments were essentially that if we continue to progress economically, as all the indicators show, they are likely fully reserved for any type of credit deterioration. And actually, you could see reserve releases in the second half of the year, which would be an earnings surprise that the street is not expecting. And those types of earnings surprises are typically what drive shares higher. So that's a very positive data point for banks specifically as we think about the second half. Now, if we do hit more difficult economic times in the back half of the year, if we have a second wave of COVID-19, then there likely would be more reserves needed, and that would depress earnings. So it really does depend on the economy, and it depends on the trajectory of the virus.
I think we certainly need some nice surprises. You talked about financials and how they're attractive. What other sectors are you finding some nice opportunities in right now?
Sure. So one area we've liked for a long time and we continue to like it is consumer staples, kind of the boring food companies, household products companies. At a high level, big picture, these companies are some of the bluest of blue chip companies around. They have great financials, high return on invested capital. They generate significant amounts of free cash flow. They are economically defensive. So they've held up well in recessions in the past and through this COVID situation that we're in. And they also have very attractive dividend streams. And so for private client investors specifically, to us, it makes a lot of sense, given where interest rates are, to think about consumer staples as an attractive exposure for your portfolio. We can build a diversified set of companies in the consumer staples space with dividend yields currently in the 3 to 3.5% range that will importantly grow over time. These are dividend aristocrats that have grown their dividend. That means they've grown their dividend every year for at least 25 years. So if you think of what else occurred, the global financial crisis, COVID-19, they've consistently raised their dividend. So you can really think of some of this exposure almost like a bond ladder, like you would do in fixed income. But importantly, that income stream will grow every year, 6, 7, 8%. So it's like a coupon payment that grows. So we really like that exposure. We think it will serve investors well. And yes, they've benefited from some of the recent trends with COVID, the stock up activity you're seeing, but we do think that continues to have legs. We think that consumers will start to go back to restaurants, but we're a long ways away from getting back to where we were traffic-wise before COVID-19. So we do think food products, household products in general, will have a nice tailwind as we look forward.
I think your point about rising dividends is critical too, because I think when you have a sell-off, a lot of people get caught in the trap of looking at companies that do have high dividend yields, but not looking at the trajectory. Or is it likely that those dividend yields are going to continue to rise, or is there a chance that they're going to get cut? So I think that's a good point about looking at balance sheet quality.
Yeah, that's absolutely right. You never want to stretch for yield. We're really more interested in future dividend growth. So yes, you can buy a company with a 7, 8% dividend yield, but that in today's environment, the market is telling you there's a high likelihood that that gets cut. But we feel very good about some of these blue chip companies, the PepsiCos, Procter & Gamble, that have 3 to 3.5% yields that will grow consistently over time.
We've talked about some positives, which are always fantastic to talk about, but let's talk about there's a lot of risks that are still out there right now. Kind of what are you most concerned about? What keeps you up the most at night right now?
I think the biggest uncertainty today is the track of the virus. So as we get into the second half of the year, do we see a second wave in the fall? Do we unfortunately need to go into another type of lockdown situation, which frankly, most companies wouldn't be able to stand another lockdown like what we just went through. And so that is uncertainty that is hard to gauge right now. So that's probably the biggest risk. And we also happen to have an election in the fall. So you compound that, there are events that will add uncertainty to the market. That's why we continue to think it's important to focus on the higher quality end of the spectrum. We want companies that were able to withstand the recent economic downdraft, that are positioned well for the future. So should we see more difficult times, they'll be able to weather that, and they'll, over time, continue to grow their intrinsic value.
Now, something we've talked about on several of these calls in the past is kind of how Westwood looks at risk and our risk management process, which I think is such a great part of our culture. And so when you're looking at large cap value and running that strategy, how are you incorporating risk and risk management into your process?
Sure, that's a great question. So we spend a lot of time focusing on risk processes internally, how we assess and vet risk at the various stages of our process. And I would say at first it starts with our philosophy. Again, I've mentioned it before, we focus on higher quality companies. That means they generate free cash flow, they have high return on invested capital, they have conservative balance sheets. And so when you invest in that type of business, truly high quality, durable, competitive advantaged businesses, you can take a lot of the permanent capital loss off the table. So we start with that. From there in our process, once an analyst identifies a high quality business that is undervalued and is recommending the name, it gets vetted by our entire research team. And so that vetting process you can really think of as a quality control check on every idea that comes through. It's a second set of eyes to make sure we didn't miss anything. And then at the portfolio level, we do employ limited position sizes. So we're not holding 25% of a client's portfolio in one stock. We use diversification to our advantage, and that served as well also from a risk control standpoint.
Thank you so much, Matt. So what I'm basically hearing as some takeaways is there are still some nice opportunities in the market, but it is an environment where you have to be really risk aware and understand the level of risk that you're taking in an investment. Look at balance sheet quality and not stretch for yield. Very much appreciate you joining us today, and as well as all of the individuals who called in and listened to our conversation. Thank you so much, and I hope everybody has a great week.